Hi, and welcome to Accessing Income, Building High-Income Portfolios Using ETFs, the latest in the series of Index Universe webinars. My name is Matt Hogan, President of ETF Analytics and Global Head of Editorial for Index Universe, and I'll be your host for today's webinar. I'm pleased to be joined today on the call by two, honestly, of the smartest people I know in the income space, Jeremy Schwartz, the Director of Research at WisdomTree ETFs, and Joseph Barato, founding member of Arrow Shares and the CEO and Director of Investment Services for Arrow Funds. I talk to a lot of issuers in my day-to-day job, and I can honestly say that Jeremy and Joe are two of the few people that constantly surprise me with fresh ideas, fresh data, and interesting insights. So I'm very pleased to have them on the call today. The format of this webinar is very straightforward. I'm going to kick things off with a 25-minute presentation on the topic of yield and ETFs. I'm going to talk about the challenges that advisors face and how they are using ETFs to boost the yield of their portfolio. We'll talk about some of the risks and the opportunities that exist in the ETF space. And then we'll bring in Joe and Jeremy for an interactive audience Q&A session. As a participant in this webinar, you're invited to ask questions of me or the panelists using the Q&A tool at the bottom right of your webinar browser. Please don't wait until the end to ask questions. Ask them throughout the webinar as they occur to you. We'll collate the questions and answer as many as we can during the Q&A session at the end. We always get asked this question, so I'll say it up front. A recorded version of this webinar, along with the slides, will be made available on indexuniverse.com, our website, within a few days. As a participant in this webinar, we'll send you an alert by email when those slides and that recording are posted. With that, let's get started. So why are we here today? Well, honestly, we're here because investors are hurting. They need income, and a traditional portfolio isn't getting it done. If you look at a classic 60-40 portfolio, 60% in the S&P 500 and 40% in long-dated Treasuries, right now it's yielding about 2.4%. 5 years ago, that was 3%. 15 years ago, almost 4%. Think about that for a second. The total yield before expenses on a 60-40 portfolio has dropped by nearly 40% over the past 15 years. An investor who retired with a fixed expectation of their cash payout may find it hard to make ends meet with a portfolio yielding a little over 2%. To make matters worse, inflation is up. 15 years ago, in '97, the CPI was running at 2.3%. Last year, we hit 3.2%. The reason for the decline in the yield in that portfolio is pretty clear. Just look at these next two charts. This is the yield on the 10-year Treasury. Except for one brief moment around 1941, the yield has never been so low. Moreover, we've just been in a meteoric fall since the late 1970s when yields briefly peaked above 14%. It's just been down, down, down. And most recently, the combination of easy monetary policy from the Federal Reserve, including open market purchases of Treasuries and MBS, have pushed yields below what many would say are fair market value. This chart is particularly scary for retirees, of course, for whom the 60-40 portfolio is likely too risky and too heavy in equities, who may be 40-60 or 20-80. To them, this crashing yield hurts even more. On the flip side, the dividend yield offered by the stock market has actually risen since 2000, but it remains down sharply over the past 2 decades. I love this chart, which comes from Shiller's Irrational Exuberance. It stitches together the best index data we have pretty much since the start of the modern stock market. Since the 1920s, it's the S&P 500, but it goes all the way back to the 1881. And what you see is startling. Where investors used to get almost 10% yields, we're now cheering because yields have risen from their bottom of around 1.2% up to 2%. The small uptick in the dividend yield is certainly welcome, but when you view it against the historical average, which just on an eyeball basis looks somewhere in the 4 to 5 range, 2% is quite low. It's worth mentioning that this low yield comes despite the fact that 402 of the 500 S&P 500 companies actually pay dividends now. That's 80%. Investing in stocks used to be primarily about dividends, but now companies are stingy, and that results in the lower yield we're seeing today. But the truth is, there's a huge variety of yields out there. The ETF space has opened up corners of the market and potential yields that were simply unavailable just a few years ago. From every potential slice of the bond space, and funds yielding everything from 0 to 4 to even 7% if you look into junk. You're talking about a wide spread of possible returns. Bank loans and preferreds push that above 7% in some cases. Remember, yield means different things to different people. Some retirees rely on income to pay their bills, and for them, yield is an absolute amount of cash in their bank accounts each month. Others see yield as a kind of buffer against the markets, a reliable, fixed return that can shield the market from downturns. Still others are chasing yield as a way of getting at high returns. I certainly hear people regularly ask me if the high-income trade is getting crowded, and that's something I'll ask Joe and Jeremy when we get them into the conversation. So in order to determine what portfolio is best for each type of investor, it's first important to understand the different sources of yield. And also, of course, the different sources of risk. Because as you'll see throughout the rest of this webinar, risk is a key determinant of yield. Viewed narrowly, the more risk, the more yield. A longer-dated U.S. Treasury portfolio may not have any default risk. I'm saying that with a smirk, of course. But everyone agrees it has significant interest rate risk. Corporate bond portfolios face both default and interest rate risk. Dividend-paying equities have an entirely different set of risks, as do MLPs, senior loans, and preferred shares. And we'll go over those in the remaining slides. So in this presentation, what we're going to do is walk you through the various risks and potential returns available to yield-seeking investors in the ETF space. We'll dig into particularly some of the alternative ETFs that are available today and examine how different ETFs provide different exposures, even when they claim to be providing exposure to the same general high-yield area of the market. In the end, we'll look at how to incorporate these choices into a portfolio and talk about ways to diversify away some of the risks that investors get stuck with in the income space. We'll move through this slide pretty quickly because it's familiar to most of you. But one key thing from our perspective is that ETFs have opened up the fixed income market in such a way that you can now target the exact risk and yields that you're seeking. On the low end, you can get absolutely no risk and basically the same yield on funds like BIL, the 3-month T-bill ETF. Or you can step up your interest rate risk into long-term treasuries and pick up 3% yields. Similarly, you could move into the corporate side and seek out 3.6% or even 7% yield. That 7% yield stands out to a lot of people. There are now 22 high-yielding junk bond ETFs, which have attracted nearly $7 billion in inflows since the start of this year alone. Think about that, $7 billion. We've started to carve up the corporate space so finely in the ETF industry now that you can actually now target your exposure specifically to one industry or another, utilities, financials, industrials. Each has its own outlook, cash flow stream, yield, and risk, so you can get exactly what you're looking for. Our point is that it used to be that you could just buy the ag and be done with it on the fixed income side. But since the government takeover of agency risk, the aggregate has become so heavily dominated by government securities that even John Bogle himself told me that he thought the ag was too heavy in governments and he wouldn't just track the index in the bond space. You can see here the ag's yield skews heavily to the low end of the spectrum because so much of its risk is guaranteed by the federal government. The point of all this is that ETFs, by opening up corners of the market, now allow advisors to manage their bond portfolios the way they have historically managed their equity portfolios, strategically using narrowly focused tools to over or underweight various corners of the market and get the exact exposure and risk that they want. I want to spend a few slides digging into these options before moving on to equity income. The safest and therefore most conservative bond portfolios available are those that own the safest income-producing security in the world, U.S. short-term Treasury instruments. That does not mean, though, that every short-term Treasury ETF is the same. BIL, for instance, owns only U.S. Treasury issues that have less than 3 months to maturity. SHY, on the other hand, owns T-bills with 1 to 3 years to maturity. And as you can see, SHY and BIL differ significantly. SHY offers 24 more basis points of yield than BIL, but as you'd expect, it has an average maturity 16 times longer. And while the two funds face the same identical risk of default, essentially zero, you can see how this translates into a significantly different total return. There's a third short-term ETF out there that a lot of people focus on, Mint from PIMCO, a massively popular short-term bond fund. Its portfolio has actually a lower average time to maturity than SHY, but it produces nearly 4 times the yield. What gives with that? Well, for one, Mint's portfolio owns commercial paper, short-term and government bonds, agency securities, and other bonds. The introduction of default risk overwhelms the lower credit risk in this case, and the aggregate portfolio of bonds that Mint owns is therefore required by the market to pay more yield. Now, as was the case with short-term portfolios, the further out you go on the maturity spectrum, the more interest risk you're assuming, and the more yield you can demand for that risk. The results can really be dramatic. Here we're going to hold default risk constant by looking at 3 U.S. Treasury portfolios with different terms to maturity, and therefore different durations, to highlight how portfolio yields and volatility both climb as the time to maturity increases. IEF is the shortest of the 3, focusing on Treasury notes with average maturities 7 to 10 years out. TLH moves out to 10 to 20 years, and TLT stretches 20 plus. If you look at the difference between IEF and TLT, you're doubling your yield as you move out the curve, back into an area where at least you can imagine living on 3% a year. Duration, of course, measures each fund's sensitivity to changes in interest rates, and you can see the impact on volatility. In a rising rate environment, TLT will feel that very hard at the far end of the curve. A muni bond is another very different animal than a Treasury bond, issued by states and municipalities as opposed to federal government, so they introduce some default risk. As you can see, muni bond portfolios are currently, at least, yielding more than Treasuries. Now that's interesting, of course, because you have a tax benefit with muni bonds that you don't get in the Treasury market. But you can see how a muni bond ETF like MUB stretches out its credit exposure across the spectrum. You're taking on more credit risk and therefore receiving more yield, even though you have that tax benefit, and even though in this case the duration is lower. Corporate bonds stretch that risk category even further, placing a huge emphasis on credit risk and often moving far out the credit spectrum. In theory, the added interest rate payments should cover default losses with a bit of extra income to compensate you along the way. The lower the credit rating, the higher the yield, and you can see the comparison between AG and LQD here. One important thing to note is as you reach down into the corporate space, the ETFs in question become very different, and the exposures you get become very different. The 2 most popular junk bond ETFs, for instance, are HYG from iShares and JNK from State Street. Both are exceptionally popular, particularly recently. HYG now has nearly $15 billion in assets under management, while JNK has almost $12 billion. Together, the 2 funds have attracted more than $10 billion in net inflows over the past year, and close to $7 billion in the past 4 months alone. I find that number astounding. But what's often overlooked by investors considering these 2 funds is that they are actually very different. Sure, they're both junk bond ETFs, but they hold different portfolios. JNK is and generally has been the riskier of the 2 portfolios, moving further out the credit spectrum and further out the yield curve. You can see that has translated into a nearly 10% higher yield currently, 7.6% versus 7.0. That may be good or it may be bad because it comes with commensurately higher risk. iShares this morning actually took this risk spectrum one step further, launching an ETF that targets bonds at specific points of the curve, in this case only the junkiest of the junk bonds with credit ratings of B through CA. So now you have a spectrum of choices from HYG to JNK to the new iShares fund at the lower end of the junk bond spectrum. You can target your exposure even within as narrow a category as junk. Investors can, of course, diversify their fixed income exposure internationally as well, either globally, internationally ex-US, or regionally. And as with their domestic counterparts, ETFs holding foreign bonds come in many iterations: sovereign portfolios, corporate bond portfolios, aggregate portfolios. Unlike domestic bonds, of course, government-issued bonds are not necessarily safer than corporate issues overseas. Some countries, particularly in emerging and frontier markets, have lower credit ratings than foreign corporations and honestly have spent a long time in default over a historical basis. We might not be so surprised by recent headlines if we remember that Spain itself has defaulted on its debt 13 times in the past 200 years. You do, however, get interesting statistics out of this. You take two ETFs like IBND and LEMB. LEMB owns sovereign debt for emerging markets, while IBND owns a collection of corporate bonds issued by foreign corporations. The two portfolios have similar durations and times to maturity, and yet because the aggregate risk of default of the bonds issued by corporations in INBD's portfolio is lower than that of the bonds issued by the countries in LEMB's portfolio, IBND carries a lower yield than LEMB. Does that make LEMB a deal, or does it just reflect reality? I'll leave that for you all to decide. Of course, bonds aren't the only place to search out income in the ETF space. Dividend-yielding equities are a huge piece of the market, too. They've been extremely popular recently, not to the extent of junk bonds, but still doing quite well. The largest dividend-focused ETF, the iShares DVY fund, has about $10 billion in assets and pulled in $180 million in new cash this year. So why are investors attracted to dividend? The biggest reason we hear from investors actually has less to do with income and more to do with total return. This chart compares the performance of the 5 tranches of the S&P 500 made up of the lowest to highest yielding securities in that index, going all the way back to 1957. You can see that the growth of the 2 highest yielding categories has far outpaced the growth of the market as a whole, while the low yielding stocks have done poorly. Why? Well, for one thing, dividends are a constant source of return, a 2, 3, 4% drip of return that can't be negotiated away by market movements. And second, according to some, investors are compensated for the increased risk of equity income with higher return potential. There is no reward without risk, after all. In this case, over the long haul, that risk has been well compensated. And how do you access dividends is another question altogether. There are currently 32 high dividend ETFs on the market today, and they differ wildly from one another. I'll call out a few here: DVY, the oldest of the bunch, VIG, a new fund from Vanguard, and DHS from WisdomTree. Each one of these ETFs has different rules for weighting and selecting dividends. DVY looks at 5 years of dividend payments and 5 years of growth per share. VIG is even more stringent, looking for companies that have hiked their dividends for 10 consecutive years. There are ETFs out there that require 25 years of raising dividends. DHS, by contrast, takes the top 30% of the U.S. market by yield. Now, this may sound like indexing minutia, but it's actually very important. By having a 10-year rule, VIG is very stringent. The companies that make it are true and steady dividend payers who will likely go on paying dividends forever, or at least for a while. However, the methodology won't even consider a company like Apple, now one of the largest dividend payers in the market, for 10 years, because it just started paying dividends this year. The more stringent the dividend screen, the safer the stocks in the fund from a yield perspective, but the longer it takes these indexes to react to changes, and you see that way out in the yield that these various strategies pay. Similarly, how you weight securities matters too. VIG weights stocks by their market cap, diluting the yield. DVY weights by dividends per share, while DHS weights by the dollar size of the dividend payout. As a result, a portfolio like DVY will skew well down the cap spectrum, functioning almost like an equal-weighted fund, while VIG and DHS will skew large. There are also ETFs like DTD from WisdomTree, which own all the dividend payers in the market. At the end of the day, you get very different yields and very different portfolios. DVY is 30% utilities, VIG is 2%. VIG is 38% consumer, DHS is 18%. And the yields range from the mid-2s to the mid-4s. There are areas of the market where ETF choice matters more and areas where it matters less. This is one area where it definitely matters quite a bit. Case in point, over the past year alone, there's been an 8% difference in return between these 3 ETFs over a single year. 8%. with DHS at the top and VIG, the more conservative portfolio, and lower yielding portfolio down at the bottom. Just to reiterate those differences, you can scan here at the sector holdings to see how these portfolios differ. I think I may have had the yields confused on the past slides. These yields are the accurate ones. If you look across the utilities line, or the industrials line, or the energy line, or the market cap line, you can see these portfolios just don't share that much in common. It's more or less predictable. The more stringent your screens are on dividends, generally speaking, the lower the yields you'll have. The more immediate your screens are, possibly the higher yields you'll have. And you trade off on that on a sector basis and a risk basis. As with bonds, when you go abroad, you can source different and in many cases higher yields. We pulled these from the iShares family, which targets individual countries, and I'd call out just a few names here. First at the top of the list is Spain, which is paying out about a 10% yield. I guess Greece is actually at the top of the list, almost 20%. Now, I should note that some of these are historical yields. So if you look at something like Spain, which is paying out about 10%, on a 30-day SEC basis, that drops down to 6%. But either way, it's a significant payout. The point here is that these markets are very, very different markets. They have different sector weights. They have different concentration weights. Their markets are at different stages of the curve. And you can target, really, more or less any yield you want. Now, it tweaks the portfolio one way or the other, but there are some very attractive yields in here. Alternatively, you could go global and get a consolidated yield. Now, there are more than a dozen global or internationally oriented dividend ETFs out there, and we'll call out three here covering the global, developed ex-US, and emerging markets. There's a big meme in the investing world that emerging market stocks are actually safer than developed market stocks. I'm not sure that's true. At the very least, you can see that as you move down the developed emerging spectrum, you steadily boost the yield on your portfolio. DEM, the Wisdom Tree Emerging Markets ETF, is currently paying nearly a 7% yield, with big weights into Taiwan, Brazil, and South Africa. As with fixed income, when U.S. investors go outside our borders in search of income, new risks emerge. Currency risk comes into play, much in the same way it does in fixed income. A decline in the value of the local currency leads to both a decline in the value of the security and the income stream. Investors in Brazil, for instance, have been getting killed recently by the appreciation of the dollar against the real. In the past year, U.S. investors in Brazil have seen returns of negative 17%, while local investors have suffered returns of just negative 1.27%. In the past week alone, U.S. investors in Brazil lost 1.1%, while local investors saw gains of 1.1%. Those same moves have impacted the dividend equivalent of the yield these companies pay, since the payouts are made not in dollars, but in the local currency. Now, the risks may be worth it. 6.9% looks like a fairly attractive yield when the S&P is yielding 2%, but it's worth understanding that those risks exist. Outside of equities, the evolution of ETFs in recent years has opened the door for a litany of new options for finding yield. I love the alternative space because it showcases a way in which ETFs have opened up the market to people who simply didn't have access to these portfolios before. There are now 78 alternative ETFs on the market today, and more launching by the week. But even as I love this space, I worry about it. These portfolios can be hugely attractive and have hugely attractive yields, but they also come with substantial risks. Some, like corporate bonds or preferred shares, have characteristics of stocks and bonds, and the challenge is to figure out where on the corporate scale of risk and return you lie. Preferreds, for instance, are really fixed income securities. They pay a fixed dividend that is senior to equity holders but subordinate to bond holders. When things go bad, the preferred payouts are the first things to go. It's important to note with something like preferreds that the market is about 80% financials, so you're getting a huge sector-specific risk when you buy in. On the flip side, you're getting 6 or 7% yields. MLPs, to take another popular example, have exploded in the ETF and ETN space recently. There are now 11 MLP ETPs on the market, with many more in registration, and they have billions of dollars in assets under management. MLPs are a special corporate structure that allows income to pass through directly to shareholders. They're typically pipeline companies or other players in the oil and gas space. And when held individually, they have great benefits, such as deferred taxation. In the ETF format, however, the tax treatment is dizzyingly complex, and there are different yields, different outcomes, and different options for investors. The final tool ETF investors have at their fingertips is income-producing strategies. One of the beautiful things about ETFs is that there are options available on most funds, and so buy-right or put-right strategies can be fairly easy to execute. The basic principle is to sell calls, either at the money or out of the money, against a long position in the underlying ETF. You, as an investor, collect the premium for these options, the yield, while sacrificing some upside in the position. In case you don't want to do it yourself, there are a few ETFs that do it out there for you, including BWX, which is and PBP charted here. BWX is the buy-right ETF, which sells calls against the S&P 500 portfolio. As you can see from these sorts of charts, you get effectively dampened exposure to the market with some downside protection and limited upside. As of this morning, BWX was yielding about 3.8%, nearly twice that of the S&P 500, so you can see why it's attractive. Now that we know the different options for yield and their risk, we can start solving the problem of how to find more yield for your portfolio. Let's first start with the hypothetical portfolio we laid out in the introduction, 60-40 split between equities and bonds. Just for fun and to make a point about duration, we'll make it slightly more conservative, replacing the AG with bonds focused on the ultra-conservative side of the spectrum, SHY, for 1 to 3 year Treasuries. The yield on that portfolio right now is just 1.2%. It's hard to keep the wolves at bay with that kind of income. An investor looking to boost the yield could do it by simply focusing on each piece of that portfolio, making it slightly riskier and moving it into slightly higher yielding securities. In this case, we can move the S&P 500 into the dividend-screened VIG and move the bond portfolio from 2 years to 20 years in duration on Treasuries. And we boost our yield considerably from 1.2 to 2.8%. We can go even further by moving into corporate credits and the higher-yielding, narrower dividend equity portfolio of DHS. We can push our yield up to 3.8%. And if we want to get really aggressive, we can replace SPY with PEY, the highest-yielding U.S. dividend portfolio, and replace SHY with the junkiest junk bond ETF, JNK. We're no longer talking about the same kind of portfolio, but then again, we're no longer talking about the same kind of yield, 5.8% against 1.2% for the conservative portfolio. Another approach is to carve out, say, 10% of your portfolio and dedicate it to one of the many alternative ETFs. If we take 5% from the equity side and 5% from bonds, you can boost the yield of your portfolio from about 1.2% to somewhere between 1.4 and 1.7, depending on which alternative choice you make. Or, and this is something we'll talk about extensively in the Q&A, you can use multiple alternative slices to build an alternative portfolio, allowing the benefits of diversification to constrain some of the risks you would otherwise see in these individual segments. And finally, if you're targeting a specific portfolio yield, you can go way out the risk train and create a standalone portfolio of high-yielding securities that target specific yields of 4, 5, 6% or more. Of course, many of these can be achieved multiple ways, but you can look at something like the 4% chart and see a 50% allocation to high-yielding stocks, a slug of long-term treasuries, and a substantial portion in investment-grade bonds. Swing over to the 7% portfolio, and you have to plow 80% of your portfolio into JNK and round it out with small slugs of MLPs and preferred shares, not for the faint of heart. The beauty of the ETF space is, thanks to the massive amount of innovation we've seen over the past few years, there are now ETFs covering nearly every segment of the market and offering just about every possible yield. The market may only be giving you 2%, but if you approach it creatively, you can find other sources to boost that yield to the point you need it to be, assuming you're willing to bear the risks. And with that, I'd love to bring in Joe Barato, founding member of AeroShares, and Jeremy Swartz, director of Wisdom Tree, for a live Q&A. I'll remind everyone, as participants in this webinar, you can ask questions of me or my panelists using the Q&A section of your webinar tool. Don't hold back. We'd love to get questions from the audience. So, my first question is to you, Jeremy. We put up a slide about this. There are enormous differences between the ETFs in the equity income side of the space. There's some that require 25 years of dividends to include a security. There's some that require no history of dividend payments at all except for current yield. How do you think advisors should think about these ETFs when they're choosing between what's really a couple different dozen options out there?
That's a great question, Matt, and I'm glad you bring up that point. Let me start with how I think of that universe and give some context for people. The way we thought about when we created the Wisdom Tree Dividend Index, which is our broadest benchmark of all the dividend payers essentially in the U.S. Today there's about 1,300 dividend payers in the U.S. That's trying to own the market of dividend payers in the U.S. You could think of it as like the Russell 3000 of dividend payers. That would be say like the core dividend market. There's definitely a lot of other indexes that will screen. You mentioned DHS, which is one of ours, which I would say is like a value screen on top of the market and trying to take the top 30% with the highest dividend yields and trying to get those higher yielding stocks. It definitely boosts the yield on the portfolio. It could be 100 basis points or so above the total market. Whereas look at something like the broad dividend index, it's got a yield a little bit over 3% when the S&P is closer to 2%. So you get something like the broad index, which is I'd say the core dividend market that you could sort for value and you could sort for growth. You talked about something like the achievers with Vanguard and Big. The aristocrats with 25-year screens. I'd call that like the growth universe. Just like there's core value and growth in a market cap index, I'd say this is the core value and growth within the dividend universe. They definitely all will tend to show the growth screens will show lower yields than the core market, and the value screens will show higher yields than the core market. But the key thing to do, I think one of the things that you brought up, the great point of Apple, that I think a lot of people don't think about when they're thinking about screening for growth. I actually have been doing a lot of research recently on what is the potential drawbacks of the screens for growth, and I actually think people are missing that they could sacrifice the growth because they're missing out on the companies with the potential to grow fastest, and Apple is by far that number one example, where they're now going to be the third biggest dividend payer in the U.S. right now, and they have definitely potential to raise their dividends faster. And if you don't have that, you're going to miss out on some of that growth. Like Microsoft is another example. Today is the fifth biggest dividend payer. A few years ago is not in the top 20, and screens for growth won't own Microsoft again until 2020 at the earliest. So you can't just think of screens for growth as increasing your growth. You could potentially sacrifice them there at the same time.
Yeah, Jeremy, has the dividend market been changing from your perspective in terms of sort of the sources of that yield? Apple's the obvious example. Is it more or less a move into tech, or have there been sort of other shifts in who's paying dividends and what the makeup of that market looks like?
Yeah, no, that's another great point. There has been a significant change in the last 5 years, I'd say, led by the financial crisis. You had, I'd say, dividends fell on the market as a whole. Say the S&P 500 dividends fell 20% in 2009, and it was the greatest fall in dividends since the Great Depression. You hadn't had more than a mid-single-digit decline going back 50 years, and it was the first double-digit, that 20% decline going back to the Great Depression. But it was all led by just one sector of financials, and they went from paying in our index about $95 billion at 2007 to the bottom at $21 billion. So $70 billion came out of financials. Ex-financials today, dividends are dramatically up. You are now back at a peak in overall dividend levels. Financials percentage is way down. Before they made up of 30%. Today they're about 16%. You're definitely seeing tech, continue to grow. I'd say without Apple, dividends from tech sector today is about close to a little bit under $30 billion. With Apple, it's closer to $40 billion. There's about $300 billion total. So without Apple, and add another $10 billion to Apple, you're definitely getting greater weights to tech and definitely less weights from financials than they were before.
Yeah, I want to bring in Joe a little bit. Now, Joe, we don't usually let providers talk specifically about their products, but I think you're bringing to market an interesting new fund. I guess just to set the stage, can you sort of describe that in a few minutes, what it aims to achieve?
Sure. Well, first, the product is going to be launching next Tuesday, May 8th. Well, actually, not next Tuesday, May 8th, which is Tuesday, a week from this coming Tuesday. And the product is the symbol is GYLD, and it's going to be benchmarked to a new index that we worked closely with Dow Jones Global Composite Yield Index. And what I loved about this presentation today was it really touched upon really many of the aspects that you really went into. The strategy or the index approach is really to provide a multi-asset class, to provide diversification across multiple different yielding instruments, global equities, global real estate, global alternative energy, which would be, the MLPs of the world, global corporate debt, and then sovereign debt are all areas where you can extract yield. And the index is going to provide a balanced exposure, 30 securities in each of those baskets, equally weighting those exposures, and then each component will have only a 20% weighting towards it, and it will be rebalancing back on a quarterly basis. And we work with Credit Suisse to do the fixed income side because they are one of the many firms out there that has index data, but has a really good international database on the global debt and the sovereign debt structures that are out there today. So we try to take into account a lot of the factors that you brought up when it came to, we had strict screens for investability, such as region, trading, currency, liquidity, and the delivery of those securities. That's very important to get that exposure. And we focused in on high yield. So we're expecting the product to range anywhere from 7 to 12% or 9% with yield. Obviously, that's something that can change based on the price of the instruments and the underlying basket that we're looking at. But when you're over looking at yield, you have to consider the risks that come into play, especially when you're going after high yield. And I think you appropriately touched upon that in your presentation. But we think we've provided a nice core yield solution that individuals will be able to capitalize through the ETF, and we think we priced it pretty reasonably so that they can get that exposure.
Yeah. We're getting a lot of questions about specifically REITs, and I know you carve those out in the fund as one of the 5 segments. How should investors think about the REIT market as a potential source of yield by itself, or operating within a broader portfolio?
I mean, we look at real estate, and we segmented it away from the equity basket. Clearly, there are plenty of products out there today that include real estate in their equity baskets. It's usually a financial component. We segmented it out because we wanted to first, and we don't look at REITs. REITs are really a foreign way of kind of breaking out the real estate market. When outside of the United States, they're known as real estate yielding instruments. We believe that the market segmentation for real estate, even though the volatility of that basket is something that's more extreme to some extent when you go into the global markets, we believe that it needed to be separated for that purpose, and we felt that that was a good way to kind of balance out the other components that we had in the portfolio. We were very careful when we were segregating each of those buckets and building those buckets that we didn't have overlap with the sectors. We wanted to make sure that the alternative energy component, which is the master limited partnership, was strictly focusing its energy on, no pun intended, focusing its exposure to where energy was derived. And we made sure that the equity components of the portfolio didn't have that same drive, that the equities are focusing more on securities that were not driving their yield per se from that marketplace as well. We didn't want to have that overlap. We thought that was very important. And in the real estate market, there are a number of companies across the globe where we're paying very nice yields, and we wanted to segment that out. There's more risk with that, and that's why we wanted to balance it out.
Right. Now, Jeremy, we've been doing a lot of research on dividend screens. We touched on some of the things in terms of dividend sustainability. The one difference between the dividend ETFs is some include REITs and some don't. Since we're getting so many questions from the audience about that, I guess how do you think about that? Should REITs be part of the discussion on the equity income side?
Yeah, well, we've included REITs as a component of all of our U.S. and international dividend ETFs. They're definitely much more present in the U.S. than the international markets, I'd say. You maybe get a few percent in some of the other markets. Where we find a lot of REITs actually is in our mid and small cap funds for the U.S. We could have as much as in mid and small cap dividends, you could get close to 20% exposure to REITs in the mid and small cap dividends. That's probably the highest exposure we have to REITs in any of our funds. If you looked at like a broader market fund, you mentioned DTD earlier, it's probably about 5% there. In DHS, you mentioned the high equity income, that's about 8% there. The only types of REITs we do not include currently is mortgage REITs, which we felt were a different type of vehicle than the other types of REITs. But overall, for the regular REITs, we do include them.
Yeah, I got one great question that just came in, which is that one of the charts showed how we're in a much lower dividend world in the past. But should investors really care if their total returns are good? Is the whole concept of yield antiquated thinking versus total return? I'll ask that first to Jeremy and then to Joe.
Yeah, I mean, there's definitely an important framework that I think about total returns as really coming from one of three components, and there's a lot of academic research on this. The total return can be broken down into what is your starting dividend yield at the beginning of a period. So today you take the S&P 500, yield dividend start at 2%. And then what is the future dividend growth on that basket? So if you take the historical S&P 500 numbers going back to 57, it's about 5% a year over time. So that gives you a 7%, if you're building from the ground up. Starting dividend yield plus future dividend growth, that's 2 plus 5, it's 7. Now, what do you expect from changing valuations? So the changing valuations is, you showed the chart of the dividend yield going down. That's associated with prices rising. If you think of it, think of PE ratios. The price to dividend ratio has been going up as the dividend yields have been going down over time. So you've gotten a kicker, a boost from the valuations expanding essentially for the last 3 decades. Although over the last decade, as the yield went from 1% to 2%, it was about 1.4 at 2000 towards 2%, you had valuation compression as the multiple went from, I think, 75 to 50, or something maybe over 75 to 50. So that's really the question. And so you can say, how do I focus on raising my dividend yield? How do I focus on raising my dividend growth? And when I look at the basket of stocks, so I think I'm going to get valuation compression or valuation expansion to boost that return. Now, you could say, I actually think the dividend yield is understated in some ways because there's so many more firms doing share repurchases. So I actually think there's potential for dividend growth to be higher than the 5% that you had historically. So maybe this gets to the point that maybe you get a higher total return. If that you're getting less from dividend yield, you're getting more from share repurchases, so that might boost your future dividend growth slightly above the 5% you've had historical. But I think that formula really gets you focusing on what is my current dividend yield, what do I think those dividends are going to grow in the future, and then do I think valuation are going to expand or contract.
And Joe, how do you think about it? I mean, is yield antiquated? Should investors just be focused on total return? And what kind of return are we looking at with a diversified yield portfolio?
I mean, I think looking at the forward yield is important, as I think Jeremy just pointed out, and obviously in markets like 2008, the yield spiked dramatically. I don't disagree with the way he paraphrased that, and I think the idea for an investor is when you're looking at the yield spectrum and you're looking at, as you earlier started with a 60-40 portfolio and you went out to what starts around 2 and you can go all the way out to 7, you're taking on more risk. So it really depends. It depends on the dimension of how much volatility you want to put in for that extra return that you're going to be getting from that yield. Investors have to take that yield and put it back into the portfolio if they're going to think about the total return. If they're taking that yield and spending it, it's a different dynamic. But if they're looking at putting that back in, because if you think about that, when the yields are coming back to the investor, especially in like a 2008 environment, it's forcing them to buy back that instrument at a lower price, which is counterintuitive to the way most people invest today, because most investors in 2008 were selling. But if they had a yield instrument and they were taking that capital and putting it back into the market, they were dollar cost averaging back into the market. So it's very important that if investors are looking at yield, that they look at it as a dimension that can help diversify their portfolio. And total return is definitely a component. The product that we designed was designed to have that long-term view and to continue to reinvest and pour that back in. But you're going to take on more of that risk. It really is, I think, a bigger question is how much volatility do you want to take for that extra yield? And that's how I think investors should look at it as well. I think that's another dimension that needs to be looked at.
Absolutely. Let me talk about one other dimension, and I'll ask this first to you, Joe. I mentioned, 60-40 portfolio, and in my example, I wanted a 10% allocation to boost the yield. I drew that 5% from each side. Where do investors, if they're adding, say, on an alternative source of yield, where does that come from? Is it equity risk? Is it bond risk? How do they carve that into, say, something as simple as a 60-40 portfolio?
Well, our strategy that we developed is a balanced 60-40, 60% equity, 40% bonds. So we would say, take it out of both areas. But I think that's a good question. I really think it really depends on the risk profile of the customer and the client that you're trying to do this for. If you're talking about an individual that is, obviously more conservative in nature, you're going to be taking more from the fixed income side, and you're probably not going to take as much. So that is going to increase your volatility. On the equity side, I think it really depends on a more aggressive investor. I think it also depends on their profile as well, because they're obviously going to be more tilted towards the equity side. I think it should start with the product that you're looking at. If you're looking at MLPs, which are more of an equity tilt on the alternative side, you clearly want to look more at the equity portion of your basket. But if you look at what has happened at the endowment level, endowments have been slowly but surely over the last 10 years been taking most of their allocations away from the fixed income side. Obviously, they're using more alternatives, but most of the instruments that we're talking about in this high yield arena are going to give you a lot more volatility. So it would make sense for the advisor or the investor to think about replacing it with something with a very similar risk profile. So I think it should start there, because you're clearly going to be taking on more volatility for that added yield that you're looking to add to your portfolio.
Right. Jeremy, how do you think about that with a product like DHS, which is, not a broad market product? Do you consider that a separate income allocation, or is that as well as some of the broader products sort of a replacement for the core? How do you think about your products fitting into an asset allocation framework?
It definitely depends on your spectrum of, like you said, what you're trying to achieve, how much conviction you have in that belief. So I personally am a big believer in our research and the methodology behind the high dividend stock. So I could use an equity income for the vast majority of my equities in a lot of different cases. Some people may not want that tilt. They may not believe in value stocks having that long-term appeal, and they don't want the risk, because that is a 30% slice of the market. It is not the whole market. It's ignoring 70% of the dividend-paying market, and so that could exclude some growth stocks, and during big growth markets, that'll definitely lag. But if you believe in that value premium over time, that might be the tilt you want to put. So it's sort of it could be upwards. If you have high conviction, it could be 100% of your equities, but a lot of people won't do that. They could layer on, maybe they do 50-50, maybe they just put 20% in a value tilted strategy. It really depends on that conviction level.
Right. Let's address. We've gotten this question a few times. I called it out in my own presentation. High yield bonds, junk bonds, have attracted $7 billion in inflows in the ETF space in the last 4 months. Is that space getting crowded? Is there a concern there? Is there concern that the equity income side, which has been getting so much attention, is getting crowded? Any worries there from your perspective, Jeremy?
I guess I could start with the equity approach, which that's probably the data I'm most familiar with. one of the questions I've seen that I actually addressed this in a commentary earlier this year is, are dividend stocks getting expensive? I've definitely seen the same people talking about that. And one of the points I make is that the dividend stream is now back to past its all-time peak. So I mentioned $300 billion of dividends on the current constituents of our broad dividend index. The peak was $288 billion in 2007. So you passed the peak this year. But prices are not back to their peak on the dividend stocks. You'd have to go up more than 15% from today's levels to get back to peak prices. So I'd say dividend stocks have actually gotten cheaper as a whole, not more expensive. Now, of course, certain sectors, like last year, you saw, utilities had the single best performance. They lagged their dividend growth. Consumer staples, some of the healthcare stocks went up very, during the high volatility, they went up the most more than their underlying dividends. So if you do rules-based rebalancing, you do end up lowering weight to some of those things. We did that in our indexes to those three sectors. But as a whole, I'd say as an aggregate, the dividend stocks are cheaper than their dividend levels.
Interesting. Joe, what do you think about that? And do you think specifically to high-yield bonds that's an area where so much money has come in? Has that gotten crowded out?
I mean, I think it's a symptom of the environment that we're in. I mean, ideally, investors are looking for that because they can't find it in other places, and they're not clearly getting yield out of their investments sitting in their banks. So they're driving. And I think what you're seeing is more of an evolution of what's happened in the equity markets with the segmentation of just getting exposure there. We only had fixed income instruments for a number of years now in the ETF space, so it's only natural to kind of see different segments of the market kind of broken out the same way we saw sectors get broad. At first you had the broad sectors, and then you got the narrowing of the sectors. I think the reality for the investor is, when they're going there, it's going to be understanding what type of risks that are at bay for that product. Is the product going to be able to sustain a large number of investments? The corporate yield strategies that are floating down on the triple Cs, what happens when the market tightens up? How well will those products trade? I mean, that will be the real challenge for those products. I think it's a legitimate question, but I think it's an evolution of the ETF space, and to see more of these products. I think you're going to continue to see more of these products. It's just natural, and what's going to survive is going to be where the dollars flow.
Right. And I mean, is the worry there if the market tightens up that premiums and discounts will return? What's the worry for investors?
Well, the key is when you're trading at that level is that there has to be a marketplace. You have to make sure that there's a support there to be able to continue to take a vast amount of dollars. And then what does that do to the underlying instruments if those instruments are not there? These instruments can be very liquid one day, and the markets can dry up the next. So you have to make sure that whatever methodology the products that are tied to, it's thought through that, and that the market, and obviously the FCC has very rigorous standards to make sure that things are liquid. But that's the issue that I think we understand that a triple C bond for a company is very different than a triple A bond, and obviously the marketplace for that can dry up very quickly if some bad news comes out for that company, and whatever all of a sudden happens. So I think that's the dimension. So it's going to be really how well diversified are the indexes, how liquid are the securities that are tied to those. Those are all factors that I'm sure went into the design and development of those products. It's something that we thought about when we were constructing our basket to make sure that those are things that you have to think through.
Jeremy, I want to ask you two questions about sort of international bond side of the equation. I mean, is that a concern in your international bond portfolios, the liquidity of the underlying instruments, or is that sort of a false canard?
Well, I mean, we've been able to see very big. We've been able to handle big flows in and out on some of our bond funds, and we've been seeing the liquidity being very good. I mean, that it is one of the reasons why we do like an actively managed approach for the foreign fixed income, is that you can decide which issues you include. You don't have to follow just the index. You can monitor the credit quality, the trading volume, and we definitely have a liquidity-based allocation model to only include the more liquid issues. And something like our emerging local debt, you would think China could be a bigger weight, but the liquidity is just not there. So it's in what we call our bottom tier in our tiered weighting process. So that is definitely something we think about, and we adjusted and the size of the allocations.
And what about currency? I mentioned the impact of currency on international portfolios. There's certainly a big debate in the ETF space about whether hedged portfolios are better than unhedged portfolios. How should advisors think about that question when they're, tapping into emerging market bonds?
Well, that's a good question. There's really, there's a growing amount of ways to allocate to the emerging market bonds. There was the traditional, I think, what started emerging market sovereigns without the currency, the sovereign debt denominated in dollars. Then there became the emerging debt with local currency, and now there's emerging market corporates with dollar denominated. If you think about why that market is changing and how it's changing, the market is going for the sovereigns to issue local currency. The local currency market is now a bigger market. It's almost twice the size of the U.S. dollar-denominated market. And the countries that are issuing in local currency terms tend to be higher credit quality. If you look at the percent that's investment grade in the local currency index, it's a much higher percentage investment grade than the dollar-denominated. That's because, if you're doing it dollar-denominated, they often don't trust your currency. There's less, faith there, and you have to do it in dollars. So that's opening the market for the higher credit quality companies, the corporates, to issue debt in dollars. And so now you're definitely seeing that as one of the newer areas to allocate to. We think that's a very interesting space. You definitely, what's fascinating is you can get some higher credit quality companies in the dollar-denominated market than the dollar-denominated sovereign market. And you get less duration, less interest rate risk, better credit quality, and then potentially higher or similar yields. So that emerging corporates is, we think, are very interesting with the dollar-denominated market. But if you actually want the currency exposure and you believe the dollar is got its own set of issues with our debt and low interest rates, and they've got better potentially long-term fundamentals in terms of GDP growth rates, higher interest rates, better debt sustainability in terms of debt to GDPs, and you think their currencies are undervalued on a long-term basis, as a lot of people do, people are gravitating to somewhat local currency debt. It does have higher risk because you have the currency fluctuations for sure. So I think that's one of the reasons why some people still use the dollar-denominated market. But if you're willing to take that risk, the local currency is very interesting.
Right. Joe, a question for you from the audience. Can you talk about sort of the attractiveness of converts or preferreds, and whether they make up your model and what they add from a yield and risk profile perspective?
So it's a good question. We definitely, when we were looking at the design of this product that we were putting to the market, we looked very closely at what we see as an emerging alternative preferred market with the energy focus. So we focused in on our global alternative yield component of the basket is where we're focusing in on the preferreds, and with a specific focus of looking strictly at the energy tilt that's there. One thing that we did not look at and we left out were the munis. We kind of kept the muni market out of it, and a lot of it had to do with just the yields weren't there for us. But on we see the preferreds as a high yield preferreds as an emerging area. But specifically, we're leaning in and focusing strictly on instruments that would be in the energy sector. I think most of the products that are out there today, you'll see preferreds that are tilted more on the financial services side.
Right. And Jeremy, one more question to you. Do you think we're going to see more innovation in the sort of dividend equity space? Are we going to see more country-specific funds? But what's left that advisors and investors need, or is the space pretty well covered from your perspective now?
We definitely have a broad global suite of dividend strategies. We have about 27 different regions, whether it's large U.S., large cap to small cap, international, covering all those spectrums. You could slice and dice it as much as you want, and that's why we did create this whole global family. So you could get more specific, and we're definitely targeting some areas of being more specific, but we're definitely also comfortable with what we have out there because we think it's a broad global family. There's always more ways to get more fine-tuned, and it's just a matter of what's the market going to demand at that point, and we're definitely being targeted where we're going. But so I think there's a small amount of room, but I think there's a lot of great options out there as well.
Right. And Joe, same question to you. I mean, what other spaces do you see that are open in the dividend space? Do you see this market continuing to grow? Do you think this is going to be an ongoing issue for folks, or will it turn around? You know, if rates rise, will people become less interested in the income space?
I think asset classes ebb and flow with the appetite of the market. I mean, in my years of being in this business, we've seen new asset classes emerge as there's a need for them. I think what's interesting about what's happening in the ETF space is that the plethora of products that have opened up on the fixed income side have really kind of to meet that demand. I can see more yield strategies, maybe more yield strategies that are more focused, and we're seeing it every day. You're seeing a different product come to market or new product that's in registration. I think it really depends on, I guess I don't know what it really depends on. I think it obviously depends on the investors and the appetite of the investors in the marketplace. I think the key for the investor with all of the products that are out there is that they need to study, the methodology of how those products are designed and how they can sustain themselves in the marketplace. I think that's the key. I think education and understanding, what the Wisdom Trees of the world or what the Arrow Shares of the world are doing, and other vendors for that matter. Look at what's behind, how they're providing that exposure, and I think that's what is going to be the key for the investors. I do think that yield is a very important thing right now, and that a lot of it is driven by the macroeconomic factors that are in our country today, and I don't see that changing. But I do think that yield's been a part of people's portfolios, not just because of this environment. It always will be there. So I think it's to make sure that you're looking at products that can sustain themselves through all markets.
And with that, we've run out of time. I'd like to thank Joe Barato, founding member of Arrow Shares, and Jeremy Schwartz, Director of Research for Wisdom Tree, for joining me. I'd like to thank you guys in the audience for listening. We hope to see you again on the next Index Universe webinar. We have a couple great ones coming up focused on volatility and ETF risks, respectively, in May. You can find those on our website. Find out more information about Arrow Shares or Wisdom Tree at their easy-to-find websites. And thank you, everyone, for joining us today. Hope you have a great rest of your